Welcome to JP Morgan's Making Sense. I'm John Schlegel, Global Head of Positioning Intelligence. And today I'm joined by Drew Tyler, Global Head of Market Intelligence. Drew, great to have you here.
John, thanks for having me. Great to see you.
Absolutely. It's always great to chat with you. We've done these a bunch. And today, once again, we're going to talk about what's going on in markets, especially in equities, how we see the positioning setup going forward. And given it's been a very busy start to the year with a lot of headlines, a lot of kind of volatility, it would be great to get your take on what you see in terms of markets going forward. So, I think first off, you've been quite bullish on markets for a while, and that's been the right call for an extended period of time. And so before getting into maybe a little more than the nitty-gritty around what's been happening recently, what's your kind of 1 to 2 quarter view on equities? Are you still tactically bullish? And how do you see things evolving from here?
No, absolutely. And so I would say the team definitely, we do maintain a tactically bullish stance. And our framework around this is really predicated on 3 different pillars. The first being resilient macro data, the second being positive earnings growth, and the third being a thawing trade war that results in lower realized effective tariffs. So just giving a little bit more background on each of those points. So on the first one, the macro data, we really start with kind of the view on the health of the consumer. And so we'll look at consumer health metrics, everything from wage growth to unemployment to things such as credit card and mortgage delinquencies. Then we'll combine that with several growth indicators. And a lot of the most popular ones there are going to be PMI or ISM data. And again, those recent releases point to an economy that's going to grow at or above trend. And as a reminder, trend growth is about 2% real GDP. And as you kind of mentioned, there's been a lot of recent geopolitical headlines that have really roiled markets. But ultimately, our view is that as we look at the course of the next couple of quarters and through the rest of this year, is that ultimately you're going to see a trade war where more deals are going to be signed, costs are going to be lowered, whether that's US and Europe, US and China, or whom else. But also recall, too, that the USMCA, and kind of formerly known as NAFTA, is also going to be up for renegotiation this year, too. And we think that's going to ultimately result in something that looks probably pretty similar in terms of effective tariff rates. And as a reminder, as individual countries, Mexico and Canada are the 2 largest trading partners for the United States.
Gotcha. So direction of travel, sort of similar to what we've been seeing with the potential for lower tariff rates that kind of help keep the economy going and keep markets going higher. That's awesome, Drew. I mean, in thinking about one of the key pillars being the consumer, I know you've done a ton of work on consumer cash file. So how does this look today? Are people right to be a little bit nervous or actually very positive on it, given some of the tax rebate outlook? What's your take?
Just as a clarification, when we refer to cash or consumer cash, looking at it as a combination of checking accounts, savings accounts, and consumer-focused money market funds, in which we believe that the combined total there is a more reasonable proxy for consumer health than some of the terms that some of our listeners have heard before, such as like excess savings. So ultimately, when we kind of look at the consumer cash levels, these levels remain elevated relative to pre-COVID levels. So when you adjust for inflation, what we find is the top 4 income quintiles have between 7 to 26% more cash relative to December 2019. And so when we think about what does this cash file look like on a go-forward basis, what's interesting is we had reached a peak, let's call it 2021, 2022, and then you have a dissipation rate that's there, kind of anywhere from like $8 to maybe $10 billion a month. But what's interesting is that as you fast forward to 2024, is that rather than shrinking, the cash pile has now started expanding again. And I think this is a product of, like, 1, some of the capital gains that we've seen, 2, kind of within housing, and 3, really for the first time in what feels like a generation, is getting a positive return from like your savings account. And I think all of this kind of goes to kind of build that cash file a little bit higher. And so to your point, when you start to think about some of the features of the one big beautiful bill, so higher tax refunds, what does this mean for corporations, is also another fiscal tailwind. I think what's going to happen here is like some of the lower income quintiles are going to see an outsized benefit from this. And then what we typically see as Americans is if we have more money, we tend to spend more money.
That seems to be very true based on the direction of travel that we've been seeing for the consumer. One of the things I wanted to chime in with on this front is, I think to your point, the consumer remains in a pretty good spot. And we've seen some pockets of the consumer stocks do reasonably well, not all, but it still remains a very bifurcated, I think, and sector in terms of how clients we see positioning in them. So we've seen clients, especially relative to where we were around Liberation Day in April of last year, a lot more bullish and positive on some of the traditional retailing companies. but they're actually still very bearish on a number of restaurants and some consumer services more generally, and even airlines, which was probably one of the hottest hedge fund themes about a year ago, still remains a lot less well owned than it did back then, even though it did have some increased kind of performance and positioning into the end of last year. So it still seems like there's a lot of different puts and takes on different themes depending on kind of how they line up with the broader macro, with some of the commodity pressures, et cetera. So really interesting to see how that continues to play out over the next few months. Maybe, Drew, digging in a little bit to some of the headlines we've seen at the start of this year, what do you think has been maybe most impactful, or what are some of your takes on these things that have caused a bit of volatility in the markets?
Yeah, sure. So let's think about a couple of different scenarios here. I think first we can kind of look at maybe it's US and Greenland, or we can talk a little bit about US Venezuela, US Iran, or lastly, kind of Russia, Ukraine. And I think when we start with US and Greenland, this ended up having a little bit more of an impact on European equities. And so some of the risk premium built in was a little bit stronger there than on the US side of things. Ultimately saw that kind of unwound as it feels like cooler heads prevailed. But really, when we kind of look at what are the things that are probably going to be most impactful on a go forward basis, quite clearly, if you see a ceasefire in Russia, Ukraine, this is going to have a couple of effects. I think first is it would be a negative for oil prices as well as nat gas. As the thought process is any ceasefire and deal there will probably reopen some of the Russian supply. And I think markets will try to get ahead of that. But also, too, the rebuild of Ukraine and think about infrastructure plays that are there, too, would really probably see a boost. And that, again, that's going to be mostly going to be European stocks. When we think about trying to tie geopolitics to the US, it's mostly through oil that is where we see this happen. And so, on one hand, you have US Venezuela, which is going to increase supply, with the US now responsible, let's call it, for about 30% of the world's proven reserves. When we think about US Iran, and any armed conflict that's there would actually be negative for oil supply, and which means that oil prices would go higher. And to me, I think the dominant effect here would be if you saw Iranian supply kind of get compromised, then I think that would have a larger impact. So those are kind of the situations that we're monitoring. To the extent that we want to kind of think about US geopolitics, we look at this solely through the lens of the impact on the midterm elections. And typically what happens is the incumbent's going to lose about 15 seats in the House and maybe one or two seats in the Senate. And obviously that can swing a little bit more one way or the other, as we've seen the US population is focused pretty acutely on affordability and what that can kind of mean. So when we think about if there is some sort of conflict in Iran and oil prices spike, that would typically be something that's negative for the incumbent party.
I think that could definitely have some impacts on the affordability side and the good or okay vibes on the consumer. I think what's been interesting on the energy perspective, from what I see, is there hasn't been a whole lot of real chasing, despite energy being one of the best sectors year to date. So we'll see if that longer term underweight finally starts to change. Pivoting a little bit to the US and the earnings season, which is really started, but now going into full swing over the next 2 weeks with a lot of the Mag 7 earnings coming up and other companies. How are you seeing it shape up so far? And do you think it's going to be a strong catalyst going forward over the next couple of weeks and beyond?
So about 13% of the S&P 500 have reported thus far. So I've got good news and I've got great news, right? The good news is that earnings appear to be growing around 8.2% on a blended rate. And when I say blended rate, what I mean is that's a combination of who's actually reported plus what we're forecasting for the companies yet to report. And so the 8.2%, certainly this would break a string of 3 consecutive double-digit growth quarters. But the good news is it still is pretty robust growth. The great news, revenue side. Revenue is growing about 7.8%, again, on a blended basis. And this would be the strongest quarter since 2022 Q3. So not bad for stocks that feel a little bit mature. So I think that gets people a little bit more excited. And now more specifically, when we think about the Magnificent Seven cohort and mega cap tech more generally, those earnings started to kick off this week. Now, Mag 7 has been a group that kind of coming in to the end of the week, Jan 23rd, the group was basically flat year to date. Now, if the earnings picture starts to improve and you bring money back in, then that's one of the things that really kind of gets US stocks really going, because as a group, they're about 35% of the S&P 500 in terms of weight. So if that group is going, the S&P is going. And one of the things that we've seen so far year to date is the S&P has underperformed the Russell as well as a number of international indices. Mag 7 earnings going to get tech going, could be the catalyst to get the US back to the top of the leaderboard, so to speak.
Yeah, no, I think this will be one of the key things to watch in the next couple of weeks, and probably one of the biggest shifts that we've seen in terms of positioning versus 3 months ago is in Mag 7, where coming into late October, tech stocks have been doing very well. Seemed like everyone was max bullish on the space. And this time around, it's been a little bit more caution. So a lot more average positioning relative to the past few years rather than extremely bullish. So I do think this could be an interesting catalyst if things go as planned in terms of the upside as you see it. So then maybe just more broadly, is there any other themes or sectors that you are extremely focused on going forward that could perform particularly well?
No, absolutely. So, kind of the hockey stick way of getting there is first we're starting to think about just the growth of the US and the potential for rate cut expectations to continue to go lower. So, right now, our chief economist for the US, Mike Ferroli, he is forecasting no rate cuts for this year, whereas the bond market's pricing in about two-ish cuts. As those cuts are pulled out of expectations, what typically happens is you'll see that yield curve flatten a little bit. Yield curve flattening typically is a bad thing for things such as cyclical as well as small caps. So if we continue to see this theme proliferate through the first half of the year, what I would anticipate happening is combine this with more with better Mag 7 earnings, and all of a sudden you kind of have that flood of assets kind of going back in. But more generally, I do anticipate there to be a broadening of the rally, but I think that it might be more localized and large caps irrespective of sectors. So when we think about things such as financial, such as industrials, you touched on energy before. I think these are all three sectors that are going to continue to do pretty well over the next 1 to 2 quarters. And so I think you combine that with a Mag 7, and I think you put together a very compelling case for why the US could do very well relative to its international peers over the next 1 to 2 quarters.
Interesting. Well, that brings me to the last question I was thinking of, which is this rest of the world versus US theme that's been very popular at the start of this year, kind of working so far. It seems like you think that may not continue at least at the pace that we've seen it start of this year, but what are your thoughts further on that?
No, absolutely. So the first thing I would mention is the US from a GDP growth perspective is still in a better position relative to most of its international peers. That said, it is important to note that the stock market is not the economy, and a lot of this has to deal with index construction. If we were having this conversation 25 years ago, then for sure, I think it's much more tied to like what the GDP looks like. But with tech being 34% of the S&P in terms of its weighting, it's certainly not 34% of either US employment or even US GDP. And that's the reason why I kind of make that comment. So if the US tech sector is going, then the US should be one of the best performing kind of indices at the country level. And what we have seen is, as we just mentioned, is Mag 7, the core part of this, really has not performed at all year to date. We do anticipate that to change. The other things that I would kind of mention here too are that international stocks from a valuation perspective still remain pretty attractive. But there are some idiosyncratic stories that are out there. So for one of the things that we're seeing is when we think about the status of the yen and whether or not the Bank of Japan is going to intervene, we're seeing some pretty wild currency moves that are there. And that's culminated in Japanese equities starting to underperform pretty significantly their developed market peers. But when we also think about the role of the dollar here too, is as the dollar weakens, this typically is good for a couple of cohorts. First, it's going to basically be precious metals. So whether it's gold, silver, platinum, these all do very well when the dollar sells off. But the other is going to be emerging markets and international. And that's one of the trends that we've seen. And so I think that there are some idiosyncratic stories between, let's call it Asia Pacific as well as LATAM. But I think it's a cohort that will continue to do pretty well because we do anticipate dollar weakness. But I think when we look at international developed markets, that's going to be much more tied to both earnings growth and GDP growth. And I think the US is going to have the advantage in the very near term.
No, it's a lot there, Drew, that you kind of gave us. So thank you for that. Yeah, no, I think just maybe wrapping it up a little bit, sounds like there's still reasons to stay positive. One of the very high level things I would just add on that is from a positioning trend perspective, we like when things are generally heading higher or trending higher on a medium term basis, but not extreme. And that's kind of been the setup for a while. So we think actually, for what it's worth, we're not yet at that level of peak bullishness that would kind of scare us, or we're not seeing deterioration on the surface where people are actually more bearish than they are at the aggregate level. That would also be a bit more of a negative sign. So I think overall, from my stance, while people are positive on markets, it sounds like there's good reasons to be so, which you've given us a lot of. So thank you, Drew, for the conversation. This is great.
Yeah, thanks for having me. And one final thought is with the Super Bowl set, I'm going to go with my fellow North Carolina Tar Heel Drake May and the New England Patriots to win the Super Bowl.
That's awesome. Well, good luck to them.
Thanks for listening to JP Morgan's Making Sense. If you've enjoyed this conversation, share your feedback by leaving a comment or review wherever you listen to podcasts. And be sure to follow our channel so you don't miss an episode. The podcast views do not necessarily reflect those of JP Morgan Chase & Co. or its affiliates, together JP Morgan, and are not from JP Morgan's research department. They do not constitute recommendations or offers to buy or sell securities. Intended for institutional and professional investors, not retail use, it is for informational purposes only. Products and services mentioned may not suit all investors or be available in all jurisdictions. JP Morgan may make markets and trade and discuss securities and asset classes. Visit www.jpmorgan.com/disclosures/sales and trading disclaimer for more disclaimers and regulatory disclosures. External speakers' opinions are personal and not JP Morgan's views. Copyright 2026 JP Morgan Chase & Co. All rights reserved.